Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
Today's episode is a cautionary saga of GoMechanic, one of India's most promising auto service startups that raced to success, almost grabbing unicorn status, but crashed spectacularly. In March 2023, GoMechanic was acquired by a consortium led by Lifelong Group in a distress sale. Let's break the story into 4 parts, followed by key lessons for founders. Part 1. The meteoric rise. GoMechanic was founded in 2016 by a group of enthusiastic engineers, namely Kushal Karwa, Amit Basan, Rishab Karwa, and Nitin Rana. It aimed to transform car servicing with on-demand repairs, transparent pricing, and a nationwide network of partner garages. GoMechanic has raised a total funding of $62 million over 7 rounds from marquee investors including Peak XV Partners, formerly Sequoia Capital India, Tiger Global Management, Chirati Ventures, and several others. Its last funding round involved debt funding of $6 million, raised from Stride Ventures in November 2023. What began as a lean operation quickly scaled to 900-plus workshops across 60-plus cities, servicing over 800,000 vehicles with a promise of convenience and reliability. The vision was clear: build a full-blown auto aftermarket ecosystem, expand into international markets, and triple its team size from 60 to over 180 employees, with grand plans of launching an IPO in 2024. Flush with capital and momentum, GoMechanic had set its sights on unicorn status. In early 2022, it entered serious discussions with SoftBank and Malaysia's Khazanah Nasional for a large funding round that, if closed, would have valued the company at $1.2 billion. Part 2. Early warning signs. Yet beneath the ambitious projections lay serious financial irregularities. In October 2021, SoftBank and Khazanah commissioned EY for due diligence, and EY's audit uncovered grave financial discrepancies. Of GoMechanic's 1,000-odd service centers, 60 were found to be inflating revenues and diverting funds into unrelated accounts. These red flags prompted both potential investors to press pause on their checkbook, derailing the planned unicorn valuation raise. Despite the red flags, GoMechanic pressed on, driving growth at all costs. Part 3. The crash. By January 2023, the fallout was unavoidable. A money control expose dubbed it "Fraud Rocks GoMechanic," how chasing growth at all costs brought down one of India Inc.'s rising startups. Investigative reporting detailed how management had overstated revenues, masked cash flow problems, diverted funds, and effectively misled both investors and the board. In January 2023, GoMechanic announced a 70% workforce layoff, citing the need to preserve cash and shore up operations. Co-founder Amit Basan took to LinkedIn, admitting guilt and expressing remorse. Our passion to survive the intrinsic challenges of this sector and manage capital took the better of us. We made errors in judgment as we followed growth at all costs, including in regard to financial reporting, which we deeply regret. Rumors swirled about insolvency notices, vendor dues piling up, and banks freezing accounts. GoMechanic was on the brink of a complete shutdown. Part 4. Acquisition and restructuring. In March 2023, a consortium led by auto components maker Lifelong Group swooped in under a distress sale. The deal struck through Lifelong's Servizi arm transferred majority ownership for an undisclosed amount. Crucially, the acquisition was structured to keep GoMechanic's brand and operations alive rather than liquidate assets. Under new stewardship, GoMechanic underwent a systematic overhaul through the following. A. Board revamp and governance. External directors were brought in to enforce stricter financial controls. B. Service network audit. All partner garages were recertified, and a real-time analytics dashboard was implemented to track true revenue. C. Lean operating model. Headcount was optimized and non-core functions were outsourced to trim costs. The turnaround bore fruit. In the first quarter of FY 2025, GoMechanic reported its first operational profit with revenues of rupees 210 crore or $25 million from services, spares, and accessories in FY 2024. The new management project's revenue to grow over threefold to rupees 700 crore or $82 million by 2027, fueling discussions of a revamped IPO at a lower valuation. Finally, lessons for founders. Here are the 5 key lessons from GoMechanic's downfall and subsequent restructuring. 1. Prioritize financial transparency. Rigorous, real-time audits and third-party diligence are necessities. Early detection of misreporting can save reputations and livelihoods of employees dependent on the startup. 2. Sustainable growth over vanity metrics. Market share is important, but profitable unit economics are non-negotiable. Growth should be calibrated against cash burn, retention, and customer lifetime value. 3. Board and investor alignment. Invite investor directors or independent board members who can challenge assumptions and demand accountability, especially when new funding rounds loom. 4. Guard against growth at all costs mentality. There have been umpteen cases of funded startups that shut down owing to their focus on growth at all costs. Sustainable, profitable growth is the mantra for 2025 and beyond. 5. Rebuild credibility systematically. If missteps occur, own up publicly, implement third-party audits, and demonstrate corrected practices before soliciting new capital. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.